Greetings, everybody. Welcome to Liberty Call. Today is Thursday, June 8th, 2023. Hope everybody's having a fantastic day out there in the interwebs. A little bit better day in the markets. Looks we got some green here on the major indexes. Let me scroll down and look through the rest of the... I see a little more red mixed in with the other markets around the world. But, things are a little better today. We're going to cover, some jobless numbers. And the third article today is going to talk about what the author of this article thinks is going to happen with the Fed rate pause. They're already, talking about that again. We're going to pause rates. Everything's going to be fine. We're going to start bringing rates down and everything will be good. So we shall see. All right. Well, if it's your first time watching Liberty Call, I'm glad you're here. Please give me some thumbs up, likes, shares, and subscribes, follows, all that good stuff. I would greatly appreciate it. And let's go ahead and jump into the numbers for today. The Dow Jones was up 0.5%, 168 points, closed at 33,833. S&P 500 was up 0.62%, closed at 4293. NASDAQ was up 1.02%, closed at 13,238. The VIX fell 2.08% today. It's currently down to 1365. Canada was down 0.21%, Brazil was up 0.77%, and Mexico was fairly flat at up 0.09%. Over in Europe, Germany was up 0.18%. The UK was down 0.32%. France was up 0.27%. Netherlands was flat at down 0.09%. Let's see here. Spain down 0.23%. Italy up 0.81%. Switzerland down 0.35%. And Portugal up 0.62%. Russian exchanges mixed again today. The MOEX up 0.56%. RTSI down 0.3%. And the overnights in Asia, the Nikkei in Japan was down 0.85%. Australia was down 0.26%. New Zealand was down 1.19%. In China, the Shanghai was up 0.49%. The Shenzhen component up 0.13%. The China A50 up 1.11%. DJ Shanghai up 0.41%. Hang Seng up 0.25%. And the Taiwan weighted came in down 1.12% for the day. All right. So like I said, kind of mixed everywhere else, kind of up and down, but nothing too dramatic in either direction. So, all right, let's get rid of that and get into today's market recap. Stock market today, Dow closes higher as tech shines after treasury yields stumble. On Thursday, the Dow closed higher as technology stocks resumed their upward trend, supported by a drop in treasury yields. The rise in the market was fueled by the release of data showing an unexpected increase in initial jobless claims, which raised expectations of a pause in Federal Reserve actions. Jobless claims rose by 28,000 to 261,000, the largest jump since October of 21, indicating a potential cooling off in the labor market. Again, there's a lot of hope. These financial journalists and people on the boob tube and the financial channels, they just love to talk about, we're going to start slashing rates. Everything's going to be great. We got a lot, if you've ever seen the Shawshank Redemption where Andy Dufresne crawled through that, pipe of shit, we just smashed a hole in the pipe. We got to crawl out to the other side, and it's not going to be a lot of fun. Jeffries noted that there is a substantial risk of a full-blown layoff cycle in the summer as businesses seek to cut costs and improve margins. Yeah, that recession's probably going to have something to do with it. The news on the jobless claims led to a decline in treasury yields as market participants increased their bets on a Fed pause. The development benefited growth sectors of the market, particularly technology and consumer discretionary stocks. Big tech stocks, excluding Alphabet, experienced gains with Apple, Meta, and Microsoft leading the way. Microsoft also made an announcement that it would make its ChatGPT-infused AI models available to U.S. government agencies. Yeah, well, got to figure half the people work for the government have an IQ under 80. So, probably could help them out. Adobe Systems saw a nearly 5% rise in its stock price after launching an enterprise tier for its ARR tool, Firefly. The company stated that it was working with businesses to explore how the tool could enhance cost cutting and efficiency. Investors will be watching Adobe's second quarter results for further updates on AI and its planned acquisition of Figma. On the other hand, GameStop shares slid nearly 18% after reporting quarterly results that missed estimates. The company also announced the firing of CEO Matthew Furlong and the appointment of Ryan Cohen as executive chairman. Wedbush expressed skepticism about the leadership changes, stating that GameStop is doomed due to declining physical software sales and a shift toward subscription services and digital downloads. Carvana experienced a significant jump of 56% after upgrading its second quarter outlook, with adjusted gross profit per unit expected to exceed $6,000. This forecast represents an increase from the previous estimate of above $5,000. Tesla also contributed to the broader market gains, with reports of the company being in talks with Spanish government officials about building a $4.8 billion gigafactory in Valencia. Lastly, energy stocks recovered some of their losses as oil prices rebounded from session lows. This recovery came after the White House denied a Wall Street report suggesting an interim nuclear deal with Iran, which could potentially allow the resumption of Iranian oil exports. Don't we have oil under the ground here in America? I mean, seriously. The rig count has not, you can go on to, I think it's the Baker Hughes rig count. It's still down like, I think we were around 700 rigs, at the kind of when all this nonsense started, 3+ years ago. And, I think last I looked a few weeks ago, we were around 550. So, that might have something to do with the shortfall on oil, to refine into gas. So anyways. All right, dive a little deeper into the jobless stuff. U.S. weekly jobless claims race to a 1.5-year high. Economists urge caution. The number of Americans filing new claims for unemployment benefits reached the highest level in over a year and a half. But economists caution against reading too much into the data due to the volatility associated with the Memorial Day holiday. The increase in initial claims reported by the Labor Department was driven by rises in Ohio, Minnesota, and California. However, economists suggest that the narrowness of the increase by state and recent fraud in Massachusetts make it premature to conclude that layoffs have picked up significantly. Initial claims we covered an article, I think, either last week or the week before, talking about Challenger Gray and Christmas, the outplacement firm, which keeps track of a lot of this data. And we've already exceeded this year the number of layoffs that we had last year. So it is picking up steam. Economists had where was I? Highest level since October of 21. Initial claims for state unemployment benefits rose by 28,000 to 261,000 for the week ending June 3rd, the highest level since October of 21. Economists had expected claims to reach 235,000. Unadjusted claims only increased by 10,535, with Ohio, California, and Minnesota reporting the largest jumps. Layoffs in manufacturing, automobile, and transportation and warehousing industries were attributed to the rise in Ohio claims, as auto manufacturers typically close plants for retooling during the summer. Economists do not anticipate any impact on monetary policy based on the claims data. The Federal Reserve is expected to maintain its policy rate unchanged next week. The jobs market remains strong, as evidenced by the additional 339,000 jobs in May. Remember, we covered an article about that just the other day that, those numbers may not be that accurate. And the low unemployment rate, despite the recent increase, job growth has been driven by the services sector, with leisure and hospitality catching up after labor shortages. However, some economists believe that layoffs are spreading beyond the technology sector to other segments of the economy. The labor market is gradually cooling off, with the ISM reporting, the Institute for Supply Management, reporting weakness in employment in the services sector. Employers are reluctant to lay off workers given the challenges they faced in finding labor during the pandemic. The number of people receiving benefits after an initial week of aid, which serves as a proxy for hiring, decreased to the lowest level since February. This suggests that laid-off workers are finding new jobs relatively easy. So again, believe what you want to believe from these numbers. The stuff out of the government is kind of some of the stuff that comes from, what I consider more credible data sources, take it with a grain of salt. It kind of depends on where they're trying to, where they hope the markets are going to go, where the economy is going to go, where the Fed's going to go, and all sorts. All right, last article here, how a Fed rate pause is likely to morph into a cut. And this is authored by Simon White, a Bloomberg macro strategist. Let's see what he has to say. He thinks they're going to start cutting rates. The Federal Reserve's next move after an expected pause in rate hikes is more likely to be a cut rather than a hike. Several factors could prompt the Fed to step back from its hiking cycle and favor looser monetary policy. Again, this person probably wants easy money because it helps the markets. Markets go up because the money's, credit, or you can borrow money really cheap and invest it. So first, it is rare for the Fed to raise rates again after pausing, especially when rates are already restrictive, says who. Second, rates are already considered very restrictive with real policy rates expected to be well above the estimated neutral rate. The yield curve inversion further highlights the degree of restriction in real policy rates. The inflation backdrop is also expected to change, with headline CPI inflation projected to fall and core CPI likely to continue decreasing. Excuse me. Fresh squeezed lemonade. No sugar. Wage growth, a key indicator for the Fed, remains relatively low, and recent employment data show downward revisions to compensation and labor costs. Additionally, forward-looking employment indicators like temporary help and average weekly hours worked are declining rapidly, suggesting a potential weakening in the jobs market. The stock market also plays a role in the Fed's decision-making, despite the variability the vertical buying frenzy in certain market sectors. Historical data shows that the market tends to rally into the first rate cut of the cycle. This trend holds true for the largest stocks driving the market higher. Uncertainty from rate hikes in countries like Canada and Australia adds volatility to the Fed's outlook. As time goes on, the Fed will have more opportunities to refrain from further rate hikes, and the longer it waits, the more favorable the backdrop becomes for policy loosening. And the anticipated pause in rate hikes may serve as a prelude to a rate cut as conditions evolve. Yeah, so this gentleman seems to think that we may pause next month, and then the following meeting is July 25th and 6th. And he seems to think that they're going to start cutting rates, I guess, at the July meeting. I'm pretty skeptical. Inflation's still pretty frothy, in my opinion, but I'm just one guy. All right, well, that's everything I had to cover for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.